Tax loss harvesting is one of the techniques that we can utilize year after year in ways to lower your total taxable income. What we want to do on today's video is actually walk you through some different scenarios in which we've done tax loss harvesting in the past for our clients and what the impact was as we looked at it on a go forward basis. But what we're going to do is we're going to start here by looking at this chart from COVID. What we see here is that the S&P 500 outlined here with the blue chart, it fell all the way down to about 30% loss. Actually happened in about 30 days. If you zoom out until the end of the year, the S&P 500 ended up nearly about 20%. What we did in practice was, if you think about quarterly bonuses or profits from the company, you invest at the beginning of the year, even IRAs, 401k, stuff like that. You invest in the beginning of the year, okay? In a taxable account though, if it falls in value, you trade it down here with the losses, down 30%. That gets recorded on the 1099. It gets recorded on the 1099 as a loss of 30% in this example. What you do is you go from this blue investment, the S&P 500 in ETF, and we can look at the iShares Core US stock market. It's kind of a total US stock market ETF. And what you see is they move very similar in line, right? In fact, in this year, ITOT actually outperformed SPY. It outperformed the S&P 500. So what you do is we invest in the S&P 500. As it loses its value, then we move into the purple where we go into the ITOT. Once we go into the ITOT, we regain our value and we're back in growing. But it's not just in the COVID year. If we actually forward out here, if we move out until last year in 2025, what we'll see is there was a taper tantrum. And the taper tantrum that occurred at the beginning of the year in April, beginning of 2025, what we'll see is, again, stocks started the year strong. Get a pullback this time of around 15%. What we do is in that pullback, when stocks are losing money, we move out of the S&P 500 into ITOT. Now in this example, ITOT did not outperform the S&P 500. So what we do is we didn't get the full upside. Okay, we missed by less than 1%. But again, you've realized that loss. When you go to record your taxes and you report it with the CPAs, they say, all right, there was a loss of 15%, when in reality, by the end of the year, you had not only recovered all of those losses, but you had actually made back all of your money. Again, our big point that we want to point out here is that time and time again, there's opportunities for you to be proactive about taxes and not reactive. We don't have to wait until the end of the year to realize benefits of our taxation. We can snap them along the way so that these wins start to compound and it affords us additional tax opportunities. And ultimately, it grows your net worth even more. Thank you.